Hi class, today we are going to talk about A2 Milk Company Limited. So first, we look at what A2 company does. A2 produces milk that is naturally rich in the A2 beta-casein protein. The A2 Milk Company Limited was founded in February 2000 on a simple yet profound discovery that different cows produce different milk proteins that behave differently in people's bodies. The A2 Milk Company pioneers scientific understanding, operational know-how, and the commercialization of premium A2 milk products around the world. Today, they have a range of products available in Australia, New Zealand, UK, and China, with further expansion planned. The A2 Milk Company Limited listed on the NZX market in April 2004 and completed capital raising. So why should we audit the A2 company? The first reason being public companies sell their shares of stock to investors and must be audited by independent auditors. The main reasons for the audit are to provide reasonable assurance that the financial statements are free from material misstatement and to ensure that all events that can adversely affect the company have been disclosed. The second reason is that audit and assurance services provide numerous benefits to management. For example, promote benefit practices for internal controls, ensure compliance with policies and regulations, and identify operational inefficiency and waste. And the third reason is that to detect and prevent fraud. It's estimated that up to 30% of New Zealand businesses are subject to fraud, errors, and corruption. An audit can be an effective tool for identifying fraud and opportunities to commit fraud. Experienced auditors are skilled at spotting weaknesses in an organization's system and control and suggesting ways to strengthen this, prevent fraud occurring. So, there are relevant risks within the business. The inherent risk is the risk of material misstatement in a company's financial statements without considering internal controls. A2 company collecting data from several subsidiaries with the intention of combining this information later is considered to be engaging in complex work which could comprise material misstatements and give rise to inherent risk. Inherent risk can be increased because of the lack of integrity of company's management. For example, leadership that engaged in unethical business practices could negatively affect the company's reputation, leading to a loss of business and increasing the level of inherent risk. Another situation that could give rise to inherent risk involves audits performed by previous auditors. Audits that were weak or biased, or audits in which auditors ignored material misstatements intentionally could increase the level of inherent risk. A company can mitigate inherent risk by implementing internal controls. Control risk is the chance of material misstatements in a company's financial statements because there aren't any relevant internal controls to mitigate a particular risk. Control risks happen because of limitations of company's internal control system. For example, their lack of segregation of duties, documents are approved without management review, or transactions aren't ratified. If the internal control system aren't reviewed periodically, it will likely lose its effectiveness over time. Management should review the internal control system annually and update the internal controls. There are several audit implications of those risks. The chief financial officer reviews the payable details at the end of each period and determines if the list is complete. The payable manager reviews all the invoices that are entered into the payable system and department heads reviews the budget to actual report. Then let's look at the overall conclusion of those risks. The natural level of risk, that inherent risk in a business activity or process without implementing any internal controls to reduce the risk. Control risk, on the other hand, is the likelihood of loss stemming from the malfunction of the relevant internal controls a company implements to mitigate risks, or the absence of those relevant internal controls altogether. Inherent risk exists independent of internal controls. Control risks exist when the design or operation of control doesn't eliminate the risk of material misstatements. But even after a company implements the required internal control, there is no guarantee that risk can be removed entirely. As such, part of the risk might remain. This type of risk is known as residual risk, as it is the risk that remains after a company implements the internal controls. So the second part of presentation, we look at one specific financial report item called trade payables. Trade payables are initially recognized at fair value and subsequently carried at amortized cost using the effective interest rate method. They represent liability recognized when the group became obligated to make future payments resulting from the purchase of goods and services. The amounts are unsecured. So why should auditors look at the trade payables? Auditors compare figures from the current balance sheet with numbers from the previous period balance sheet. If there are significant differences between the financial statements, auditors dig deeper into the record to try to find a satisfactory reason for the change. For example, if the value of accounts payable has seen a marked increase, the auditors will try to determine the reason for this increase. They will consider whether this reason makes sense in the context of the business. There are 4 key procedures for auditing accounts payables: reviewing standard operating procedures, analyzing source documents, confirming balances with vendors, and comparing the account payable ledgers to the financial statements. We are going to look at these items in details. Standard operating procedures are critical to a properly functioning accounts payable department. The audit team reviewed them in details. They also test a sample of transactions to determine whether payables personnel follow them. Then, auditors use the term vouching to refer to the process of tracking a transaction from inception to completion. Analyzing this paper trail requires auditors to review original source documents such as purchase order, vendor invoices, journal entries for accounts payable, and bank records. Then, auditors may send forms to the company's vendors, asking them to confirm the balance owed. If the amount confirmed by the vendor doesn't match the amount recorded in the account payable ledger, the audit team will note the exception and inquire about the reason. Finally, auditors compare the amount recorded in the company financial statement to the record maintained by the account payable department. This includes reviewing the month-end close process to ensure that items are posted in the correct accounting period. In conclusion, we have looked at A2 company's profile, then we look at the reason for auditing the firm, and we discussed A2's relevant risks include inherent risk and control risk, and then the audit's implications of those risks. Then we look at a specific financial report item, accounts payable, and we discuss why accounts payable is important for A2 and the specific auditing procedures to solve the problem. And finally, this is the references for the presentation. Thank you for listening.